Joining us now, Wilmington Trust Investment Advisor, CIO Tony Roth. Tony, thank you for being here. A lot of cross currents that the market is digesting this morning. How are you interpreting everything?
Well, there's certainly a lot going on as the market tries to find its footing with the new administration. Our forecast for the year is predicated on the idea of what we call chutes and ladders. We've all played that game when we were kids, where you land on a square and you go up or down, perhaps unexpectedly. And so when we think about what's happening right now, we're coming into a year where we see slower growth than last year, probably about 1.8%, which is predicated on a slowing consumer, but also pretty significant disinflation. And our base case is for probably 4 rate cuts. So we're a little bit out of consensus there, but we do see the economy slowing. We see some significant cracks in the consumer. And the market is trying to, right now, understand how these policies, these chutes and ladders, if you will, on the one hand, deregulation and the potential for maybe even expensing to boost CapEx. And then on the other hand, tariffs and maybe the size of the fiscal deficit and interest rates are going to potentially weigh on that baseline forecast for slowing growth and a soft landing.
So is that what you see as the driver of the chutes and ladders? Is it all policy, or are there other aspects that you're looking at as well?
Well, I think that it's for the most part policy. When we talk about the chutes in particular, which are the upside possibilities to that base case forecast, it is really the potential for deregulation and M&A activity. But that, very importantly, needs to have interest rates low enough to finance that activity. And at the same time, the potential for even greater increases in productivity than what we've seen so far in the cycle through capital expenditures. So that's all policy-based. But then on the other side of the equation, we do very much worry around the idea of interest rates moving too high and really squashing the soft landing. And a lot of that organic activity in the economy, if we end up with, let's say, the 10-year above 5% at some point due to either deficit or due to inflation. So on the ladder side, we're a little bit more concerned around the organic path of the economy, whereas the chutes are more policy-based.
It does sound, Tony, like your base case is that the 10-year yield goes higher, not lower?
Well, I think that we're probably looking for a base case of the 10-year moving sideways. And the reason is that, as I mentioned, we're out of consensus on inflation. We see inflation moving to 2% by the end of the year on core CPI year over year, which is a little bit weaker than the base case. The other thing I would say is that even if we're wrong on inflation, I think that what we're going to see is an administration that's so focused on rates that there'll be a lot of narrative and focus on whether or not 3 should be the new 2, whether it's in the context of a new Fed chair coming in next year, whether it's even potentially in the context of sort of shaking up the perception of Fed independence. If we get to a point where those goalposts are potentially moved a little bit, so that we're not focused on 2%, that will also allow for lower rates. So when you put that whole picture together, it does suggest in our minds a 10-year that stays within that 4.5 to 480 or 490 range, which is where they need to be in order to fuel that M&A activity that we're talking about.
Kind of reminds me of the comments we got last week out of Waller, very dovish, and some speculation today that maybe he himself was angling for a Fed chairmanship. And I wonder if you think the rhetoric out of the committee, if that view is shared, is going to get more dovish in the coming weeks.
Well, I think that it's going to depend on the inflation data to a large degree. But I also think that depending on how independent the Fed actually is over the next 12 months or so, will have a big impact on what the Fed does. Because we clearly have an administration that has a lot of influence in Washington in lots of different ways. And there is a lot of basis for believing that 2 is an arbitrary number and maybe 3 would be just as good a number. And so if that goalpost can be moved without undermining the credibility of the Fed, which is a big question, then I think that you could end up with a lot more dovishness regardless of where inflation comes out.